becoming a professional money manager. Hi, it's Charlie giving you today's video, and this comes from as a result of a question that we had come in. And let's firstly put aside these sorts of firms that are out there that say, oh no, there you go, we'll give you £250,000 worth of money to trade with, or 500,000 or 100,000 or whatever, because in the main, those sorts of firms, they're in it to make their own money on your applications and all of that stuff that you have to do. So that's what really their business is all about. So let's talk about professional money management and what you need to do. I think there's just a few considerations here. Firstly, you would need to have 3 years track record. Okay, so generally speaking, you'd need to have a 3-year track record. You would also need really to have a given level of industry experience. Experience. So normally, again, depending on the individual, you're going to need certainly more than 3 years experience. So dare I say 10 years experience. Okay, so let's say 10 years experience. Might be able to get away with a little bit less than that, but in the main, in order to become a professional money manager, then that you're just wanting to get regulated so that you can manage money, then you're going to need something like that. So it is the long path, but then you have to also ask yourself, well, what are you doing it for? What's your reason? Now, it might be because you trade on a relatively small amount of money yourself, and you're seeing this as a means to trade greater amounts and charge your performance fees and therefore make money from managing other people's money. Nothing wrong with that. That's what hedge funds do after all. The one thing again that would raise question marks though is if your personal trading, you're trading on let's say a £5,000 account, and then you're wanting to go and trade a few million, so to speak. That's a big step up, and psychologically you might be absolutely fine trading a £5,000 account, but can you handle trading much larger capital? Can your strategy or your approach even deal with trading with larger quantities as well? So those are some of the considerations that also, you think, oh yeah, I just jump in and out of the markets, Charlie, and I trade 20 times a day and I'm scalping away and stuff. Well, if you're trading larger amounts, that may not be quite so straightforward to do. And so because of trade size. So these are some of the considerations that you're going to need to have. Now, personally, the reason I do it is because it gives, I think it gives, credibility to what I do as a trading educator. I wouldn't have otherwise been bothered. I genuinely wouldn't have been bothered about doing it, and I was approached to do it. So I didn't go looking. I was approached to doing what I do. So, and in fact, it's a lot easier than me going and writing a book, isn't it? And because people often go and write a book to get credibility, and that's just one of those sort of things. And as much as I'd quite like to write a book just to get down my thoughts, but it's time for me. And so for me, my personal reason is that actually it backs up what I'm doing, that I'm always willing to put my neck on the line. As if I'm going to be a trader educator, which I enjoy doing because I enjoy the interaction that I get from my role there, then this is just underscores all of that. So that's my sort of reason. Otherwise, I wasn't bothered about managing other people's money, professionally myself previously. So again, if that is your sole reason, because you're trading on a smaller account and you want to make more money, it's fine, because everyone wants to make more money from their trading, but just make sure that you are preparing yourself psychologically for trading larger amounts, because to take that jump from a 5k account into, let's say 500k even, you might all of a sudden, one, will your strategy still work? Two, will you, and more importantly, psychologically, will you be able to deal with trading with the higher numbers? Now, people will say, oh yeah, but I risk X amount per trade, and it's just a percentage based on a higher amount. We all know that, but you may well find the amounts, the sizes, plus also do not underestimate the subconscious pressure of looking after other people's money. It is a great responsibility to look after other people's money if you have ethics. If you don't have ethics, then you'll be absolutely fine and you'll just go off and do whatever you want and blow up people's accounts and money for them and stuff like that. So, but for the majority, it is, like I said, it's a huge responsibility, and don't underestimate again that you will feel that when you're trading other people's money. Now, again, I've been lucky that I've been doing what I've been doing for so many years that when I did come a few years ago to trading other people's money, I'd effectively been doing that for a long time anyway with what I've been doing. So we've put my neck on the line a lot. And I was already used to trading with larger funds anyway, so that wasn't a problem. And the psychological side, because I'd always spent a lot of time on the psychological side as well. So those would be my sort of general guidance points there. So you don't have to go off and take a load of exams. If you've got the industry experience and you've got a track record, then that's probably going to get you through to getting some form of regulation to be able to manage some money under a regulated entity. So those are my main points. And don't think you need to be over your 3 years of history. You don't have to be setting the world alight, making hundreds of percents. You don't have to be doing that. In fact, just remember that investors coming into your potential fund, a lot of your investors would be quite happy with relatively low returns, because if you think you could go and make investors 100% a year, but you have to have some quite higher drawdowns in order to make that 100% a year, you've got to think, how are your investors going to feel? They all want to make you to make them 100% until you're 20% in a drawdown. And then they won't necessarily feel that same that same conviction. So again, other guidance is what do you want to achieve with it. So if you're trying to make more money, you're going to have those bigger drawdowns, which you're fine with when you're trading your own money. But think about what your investors are going to be like, because then your investors will be contacting you saying, oh, is everything okay? And that by itself can then add pressure if you're having larger drawdowns as well. So, and then you end up going down this path whereby you start to really feel the pressure and all of that. So as far as performance is concerned, just remember, especially if you're trying to attract higher net worth individuals won't believe you. If I've got contacts at Merrill Lynch, for example. If I went to Merrill Lynch and said, "Oh, I've got a fund that I'd like you to recommend to some of your high net worth clients," and oh yeah, and I'm aiming to make 80% a year, they would walk away, because they know that the risks associated with that are that much higher, and therefore most investors won't like the ride that they have to go on. So in fact, you might be better off attracting money where people say, oh right, you can make me 15% in a year, can you? Fantastic. And people will quite be attracted to that. So don't think you have to go and make huge percentages, because investors will be attracted to even those relatively lower returns. So there you go. There's my general advice on becoming a professional money manager. So yeah, get yourself 3 years trading track record. Bearing in mind, if you are trading on a low amount of capital, you've really got to work on your mindset, so that you're ready, not just because to get used to trading with larger capital, but more importantly, the mindset of being able to of carrying that responsibility of trading other people's money, and it is quite a responsibility to. So you really got to try and work on the mindset towards that as well. So everything you do has got to be preparing your mind towards trading that way if you're going to be go down that path, and spend less time worrying about strategies and spend more time building up that thick skin, that resilience, and you can trade through everything, and so that you can trade in a way where you won't be impacted by whatever it is that happens to you in the market, whereby it adds pressure to what you do. Because if it adds pressure, then you won't trade well on your fund. Anyway, there you go, some thoughts for today's video.